Research on markets. A presentation by Emily Inkenbrandt-Neary at Purdue Global University for Professor Jeffrey Adair. To summarize the Bureau of Economic Analysis, capital transfers are proceedings in which possession or proprietorship of an asset is conveyed from one economic entity to another, which allows for the recipient to gain ownership of the other asset. Funds raised by the sale of the other asset are conveyed through capital transfers as well. An example they give on their website of a capital transfer includes capital grants created by the federal government for state and local governments to use toward infrastructure. How are capital funds transferred exactly? Three modes of transferring capital or funds from savers to borrowers are, with the example of podiatrist Dr. Pete Pheets, we get an insight on direct transfer. This is a relocation of assets from his tax-deferred retirement plan or account to borrower. Direct transfers are not distributable and therefore not taxable as income or subject to any penalties for early allocation. Deborah Pheets is the one who advised her father, the podiatrist Dr. Pete Pheets, in regards to dealing in the direct transfer. She goes on to say that an indirect transfer through investment bankers will have an investment banker oversee the distribution of assets such as stocks and bonds. A company's securities and a saver's money will roll through an investment banking house. The investment banker will then buy all the securities issued from the company that is in need of the financial capital. Then, investment bank will turn and sell the same securities to savers at a higher price. If one is looking to make an indirect transfer through a financial intermediary, one will seek a financial institution that joins surplus and deficit entities, such as Pheets Insurance. Agent Philip Pheets is an expert when it comes to the equal transfer of the risk of loss from one to another in exchange for cash money. Financial markets are institutions that facilitate financial transactions. How do we differentiate between markets? This is complex. Let's have the Pheets family help us answer that. The Pheets say the financial assets are assets that are gained from a binding claim, such as stocks, bonds, and securities. Physical assets are real assets, such as Pheets Manor and Pheets Factory, where they manufacture Pheets brand sheets. Pheets sheets. A spot market or cash market is where the exchange of ownership from stocks and currencies, which transfer instantly after buying or selling. A futures market is where participants buy and sell contracts for delivery on a specified date in the future. Money and capital markets are very similar to the markets we discussed on the previous slide. Just to go into a little more depth, money markets are markets for short term with maturities of 1 year or less. On the other hand, capital markets are markets for long-term financial instruments. Long-term here means having maturities that extend beyond 1 year. Here's an illustration using some of the pig livestock at Pheets Farms. The top pig's growth best illustrates the growth of money markets. And the bottom pigs, plural, illustrate the passage of time before investing within capital markets matures. To describe a primary market, it's time to meet another Pheet. Meet Philip Pheets' cousin, Cleet Pheet. Cleet Pheet is in cahoots with Deborah Pheet to open a consignment shop for babies. Not consigning babies, but more so baby goods. The name of the store is to be called Baby Pheet Consignments. Cleet and Deborah Pheet only need an investor, and they are ready to roll out this project. They should have no issue since they are planning in a market in which previously issued securities are bought and sold for the first time, or issuing of new securities to gain cash that can be used to finance business ventures. In a primary market, the firm selling securities receives funds raised, so it seems like a double win for Debbie at Pheet Bank. The secondary market is where trading of previously issued securities happen. The firm does not gain new liquidity as it sells securities that are only being transferred from one investor to the next. The private market consists of institutional investors for wealthy individuals who deem them to be worthy enough to manage part of their funds by investing them into companies with strong growth potential. In the public market, the price or rate varies according to supply and demand. The price is determined instantaneously by the comparison between the stock of shares offered for sale and the stock of shares requested for purchase. If the number of shares requested by buyers is higher than the number of shares offered for sale, the share price rises, and vice versa. This high price volatility may be considered dangerous by some people. Dangerous. Thanks for having fun with the Pheets. Resources.